So, hey, what I'm what I'm going to do tonight is how many people watched part one of this that we did about 2 weeks ago? If you watched part one, where I summarized the market, I shared a lot of charts and graphs from Marcus and Millichap. Give me a thumbs up in the chat if you watched part one. Okay, I see DeLorean watched it. I see Donna watched it. Jim Miller watched it. Good. So some of you watched it. And the good news is I'm going to give you a quick recap of that because there's some people that are on tonight that didn't watch it. And so what I want to do is I want to level the playing field. So what I'm going to do is I'm going to spend the first few minutes just doing a quick intro. And then I'm going to spend 10 minutes covering what we talked about 2 weeks ago. And then I'm going to dive into the main part of today, which is part two. And what we're going to talk about is what do we need to be doing right now to be ready and to be prepared, and what actions do we need to be taking right now? Because how many people my voice is really going out, so I'm not going to keep saying that. So I'm just going to do the best that I can. But how many people realize that there's tremendous opportunity now and right around the corner? So if you realize that, give me a thumbs up or type in yes. Okay, good. So we're going to be talking about that. And then we're going to talk about how specifically you can get ready and what actions do you need to be taking. Okay, so that's what we're going to be covering tonight. So I'm going to jump right in. I'm going to go ahead and share my screen, and I'm going to pull up my slide deck for tonight, and let's get started. So if you could see the screen that has the part one and part two that says Decoding Multifamily Investing, Mastering Now and Planning for 2024, give me a thumbs up. You all can see it? Let's see. I don't see any thumbs up. Let's see. Maynard, yep. Okay, good. Okay, I got it. Sometimes I can't see what you guys can see. So just as a refresher, because some of you are tuning in tonight for the very first time, I got into the mentoring business in 2013. I got into the apartment investing business in 2002 and was able to retire from my job in 3 years and started mentoring others in 2005 and then started my own mentoring and education platform in 2013. And we have a big mission, and that's to impact and mentor over 1 million people. Okay, and maybe I won't have 1 million direct clients, but here's the thing, like the fact that you're on this call and listening, hopefully I'm going to impact you, motivate you, inspire you, and even for the next 60 minutes, give you some content and give you some mentoring so that you could go out and do this and make this happen and become financially free. So all of you today watching in person and watching the recording are part of my mission. So thank you for that. A little bit about me for those of you that don't know. Again, this is a review for people that do know me, is that my first investment property ever was a 32-unit apartment building. And so this is evidence that you can start with apartments with no previous real estate investing experience, because I started with no previous real estate investing experience. I didn't start with a single family, a duplex, a fourplex. I wasn't flipping houses. I never had any investment property in my life. And I did not start as a limited partner. I did not start as a passive investor. And that's another myth. I started with my own property. And since then, I've helped hundreds of my students start with syndications. Okay. So I've owned almost 60 apartment buildings, 57 to be precise, over 10,000 units, over $1 billion of apartment purchase value. And 21 of those have gone full cycle. And I'm proud to say that I've been able to make tens of millions of dollars and also pay zero legally in federal income tax since 2018. And that's one of the 3 ways that apartment investing really accelerates your wealth and your net worth. because taxes are our biggest expense. And so if we could find an investment that goes up in value over time, that cash flows, and it helps you reduce your biggest expense that you have, like, why wouldn't you be interested in that? And I know all of you are, and that's why you're here. And as I mentioned, I started mentoring others in 2006. And the thing that I'm most proud of, though, is not my own investments. It's what my students have been able to achieve. So I've been able to crack the code on taking what I do and transferring it to people that are open to learning my system, my framework, my step-by-step process. And that's what I'm most proud of. And I have hundreds and hundreds of students that are out there really doing well, and hundreds have created their net worth or increased their net worth by over $1 million, and many of those have quit their jobs. Okay. So what I covered 2 weeks ago was why we should be in right now, why now is a good time. And I talked about 8 things. I talked about the fundamentals are still strong. Job growth is continuing. Rent growth is continuing. Vacancy is still low. I talked about apartments are on sale. The average price is down 20% nationwide on apartment buildings from, say, 16 to 18 months ago. And there's a tremendous opportunity to buy deals that are distressed. Let's face it, interest rates went up, expenses went up. Right after the pandemic, rent growth skyrocketed and expenses didn't. And then expenses have skyrocketed in many markets with insurance, taxes, supplies, materials, labor. Okay. And that took a while to catch up. And then with the Fed raising interest rates 12 or 13 times, I don't know how many, but they created a situation where people in variable rate loans and that bought in suboptimal markets and that didn't have a lot of experience and that didn't buy interest rate caps and don't have a lot of liquidity, these people and these investor groups are going to need to get out of their deals. And so we have opportunity. At the same time, we have a lot less competition right now. We have, instead of 30 buyers chasing deals, we have like 3. And we have more buyer-friendly terms than I've seen in the past decade. We have a shortage of housing. We have great tax advantages that's continuing to go down 20% each year. And we have an increasing affordability gap, meaning it's much more expensive to purchase a median price single family home and pay the principal and interest than it is to rent a median priced apartment. Okay, is a huge gap. And so the shift in that gap is favoring apartments, and we're still in an inflationary environment. That's why the Fed has not been lowering rates. In fact, it's likely that rates will stay flat or maybe even one more increase before the end of this year. So these are all the things we covered last time. And then I showed you an example that if we purchase a $10 million deal in $100,000 a unit and the rents are $1,000 a month, and rents go up just 3% a year, which, by the way, the annual rent increase right now is 3.1%. And so if rents just go up 3% a year, we could see how much more cash flow we have, but we could also see how much the value of the property goes up. And so that $10 million property would now be worth $13.5 million. And by the way, to buy a $10 million property, you're probably going to put 35% down, which is $3.5 million. So this is a quick example of how buying a deal and holding it over a 5-year period could double your money, because your $3.5 million down payment would be your initial equity. And after 5 years of a 3% rent growth, you would now have $7 million of equity. So if you're following that, just type in the chat like thumbs up or I'm following it, because I want to make sure you guys get this basic math. Okay, it's important to get the basic math. I'm passionate about it. Let me check in the chat box. Okay, good. So this is still a recap of 2 weeks ago. Early in 2023, I would have laughed if you told me that we were going to have a soft landing. Okay. But as the year has progressed, right now, according to some of the top financial minds and economic minds in the world, there's only a 15% chance of us having a recession, which means a soft landing is actually possible and maybe even likely. Okay. So what that means is we may not have this huge recession or this huge economic crash that people have been talking about in terms of our economy. And, there's some risks that could happen. The Fed could be unpredictable. We could have, wars break out. I mean, since October 2nd or 3rd, when I did part 1, Hamas attacked Israel. And that happened October 7th. And now we have war in the Middle East between Israel and Hamas. And there could be, that war could spread. Hezbollah could join in, Syria could join in, Iran could join in. I mean, things could get messy. And so there's risk there. And there's weather risk, there's hurricane risk, there's climate change risk, there's political risk. And so even though we expect things to go a certain way, the reality is there's a lot of things that can happen that could throw us off. Okay. And David, I see your comment that says this is wrong. Everyone I listen to says no soft landing. This is not me making this up. This is John Chang from Marcus and Millichap, who's the senior research director. And this was his presentation that I was sharing his slide deck. Okay. So I'm not claiming, yes, there's going to be a soft landing, but I'm saying the probability of it happening is more likely now than it was earlier in the year. That's all I'm saying. And I'm showing that some of the data that supports that. Okay. And so again, this is John Chang, not Brad Sumrock. And what John is showing here is that the economy is doing pretty well right now. And the GDP forecast for 2023 is a fairly healthy 2.1%. I mean, that's a fairly healthy number. Okay. So, here I am sharing you information that is not from me. It's from Marcus and Millichap, is the biggest commercial real estate firm in the United States. So I just thought it would be useful to look at that data. Okay. And one of the things that we looked at 2 weeks ago was there is a huge shortage of housing. Okay. It's estimated that there's nearly 4 million housing units that we need that we don't have. And that's 4 million single family and multifamily completions. But as I'm going to show you later today, the number of scheduled completions in multifamily is going down. There's less multifamily coming online in the future. And so that's going to further put pressure on rents. If more people need housing and there's less housing units, then vacancy will go down in the future and rents will go up. Okay. And that's what happens. And so we can look at this and we can see, if we look over to the right, there is an average national affordability gap of $1,124 a month between buying a single family home, a medium price single family home, and renting a medium priced apartment. Okay. And so that, again, that favors the working class family to be a renter. I also showed 2 weeks ago where job growth and populations are shifting. And we can see all of these green circles indicate the highest job growth markets in the country. And people were leaving the West Coast and the Northeast, and they're coming into the Sun Belt. And we could see that. And so job growth is one of the top economic drivers of the multifamily industry. Okay. And so that's job growth. This is millennials, and this is where millennials moving. And again, millennials tend to move where jobs are being created. And why do we look at millennials is because millennials are more likely to rent apartments. And again, we can see a shift from the Midwest, from the West Coast, and from the Northeast to the Sun Belt. And so that further shows us like where we need to be looking at in terms of selecting the most desirable markets. And then again, we looked at rent growth. So we looked at job growth, we looked at population growth of millennials. And again, for the most part, it's most of the same markets. Okay, the highest rent growth markets are where jobs are being created and people are moving to. And it makes sense that that's where the rent growth is going to be happening. And so we went through a lot of charts and graphs 2 weeks ago. And I'll show you some more of that, and then we'll get on with the new material. But I showed you the average affordability gap nationwide was $1,124 a month. And this is just giving you an indication of some of the markets that are above average, and in some cases, way, way above average. So we don't want to just be in an average market. We want to be in a market where it's so much more affordable to rent an apartment than it is to buy a single family home. And so you can see some of these markets here on the left side, there's a huge affordability gap. And even going down to Tampa, Florida at $1,170 a month, it's still higher than the average. And so these charts that I'm showing you with population growth, millennial, job growth, population growth, rent growth, and affordability gap, these are indications of what markets are outperforming the national average. Okay. And so the other thing we talked about is transaction volume is down. Okay. So some of my current students, the biggest challenge right now that my current students have is, Brad, there's not a lot of deals for sale. Okay. That's the single biggest challenge, is there's not a lot of deals for sale. And so what we're going to see, though, because the debt markets are stabilizing and the Fed stopped their frantic pace of increasing interest rates, we're seeing more stability come into the market now, and we're going to see more deals coming on the market. Okay, and I'm already seeing that. And what type of deals are going to come on the market? And if you look at this, we are going to see in 2024 and 2025 a lot of deals coming on the market. These are loan maturities. And we could see the number of loans that are going to mature in 2024 is going to be up substantially from 2023. And 2025 is going to be up substantially from 2023. And so the next 2 years, we're going to see a lot of deals available there where the ownership groups need to sell. Okay. And that could play into our advantage for those that are ready. And I'm going to talk about what does it mean and what actions do you need to take to be ready. Okay. So I finished the training, the part 1 training, talking about what is the recipe to select the best markets. And the recipe that I've been doing and teaching for 22 years is summarized right here. It's really simple. You need to be in a landlord and business friendly environment. Okay. You need to be in a market that has above average job growth, above average population growth, above average affordability gap, everything I just showed you. And then point number 5 is just kind of a reminder that even if you invest in these markets, you still got to drill down into the nuances. Okay, markets are local and they require having some expertise, meaning like you got to select your markets. Any of you that have invested in any of my training programs, even my home study course, I talk about how important it is to do market research and how to do market research so that you have the ability to drill down deeply into these different markets. Okay. So that's how we finished up. I gave you some of my top markets for 2023. And then I showed you some inspirational quotes from people like Warren Buffett that said, be greedy be fearful when others are greedy, and be greedy when others are fearful. And right now, the sentiment out there is that people are fearful. And when people are fearful, that means it's a great time to be looking at opportunity. And I finished up by saying, I'm telling you this, when we're here in October of 2024, people that started now or that put their foot on the gas now, if you've already started, you're going to be happy. These times remind me of like 2010, 2011, 2009. I've been in the market at that time. And let me tell you what happened. There were ownership groups, operator groups that bought in 06, 07, 08, and they were having some challenges. Just like now, there are ownership groups that bought in 21 and 22, and those people are having some challenges. Not everybody, but a lot of them. And a lot of those people will make it through because they're resourceful. They have money. Cash is not trash. Cash is king. Okay, a lot of people will make it through, just like a lot of people made it through last time. But a lot of people won't. And that's where the opportunity comes in. But I don't know anybody in 2009, 10, or 11 that said, I wish I would have bought less real estate. Everybody I know looking back says, I wish I would have bought more. And we're in those times right now. That's what I want you to know. We're in those times. So now I want to shift to some new material. And this is also borrowed from Marcus and Millichap. And October 12th, John Seabury, who's their national director, did a video. And I'm going to play the video. And it's really short. It's 3.5 minutes. But he did a video, and the title is called Is Now a Good Time to Invest in Multifamily? So I'm going to stop the share and just check in with you guys. And I'm going to go ahead and play this video because I want you to see what one of the national experts is saying. So like, this is not just what I'm saying. This is what one of the national experts is saying and why he's saying it. And then we're going to dissect it and go through each of the topics. Okay. So let me pull this up. See if I can find it. It's always interesting how to best share. So could you guys hear me now? Okay, so here's what I'm going to do. I'm going to share this video, and when I go to share the video and optimize for sound, I think what happens is it mutes me. So I'm going to start playing the video, and then I see some of my team members here. So Ivy, when I'm playing the video, could you tell me if you could hear it and see it? Could you do that, Ivy? Just tell me yes. Okay, great. So Ivy is going to be, I'm going to be looking at the chat box, and I want to make sure that I can do this here. So yeah, now I'm going to be muted. So I'm just going to hit the play button.
In recent conversations with investors, several of them have told me that now is the time to buy, that they're being very, very aggressive and going after deals that are coming on the market. Their approach to the market is to find a strategy. They have to have a strategy. What are they going to be able to do to really create value? Determine what your cap rate is going to be. Maybe it's a 5.5, maybe it's a 6. It's probably not going to be a 7 in today's market. You have to understand exactly where interest rates are, agency debt or bank debt. And you've got to keep in mind that you may have to underwrite negative leverage for a short period of time. These investors are being very aggressive because they feel that now is definitely the time to go into the market. There will be a limited number of transactions coming to market over the next several months. So once you've determined what your parameters are and what your investment strategy is, you're going to have to be very aggressive on any property that comes within that zone. The other aspect to keep in mind that's going to be critical in our industry moving forward is property management. Now, in the past several years, property management has not been as important just because we've had very strong rent growth and we've had appreciation. But as expenses have increased a little bit over the past couple of years, and moving forward, making sure that you have an efficient property management operation is going to be critical to maximizing values. Let me identify three main factors that I'm looking at that really explain why now is the right time to buy. The first part of it is that fundamentals remain strong. Occupancy remains very high, rent growth continues to be very strong, and we're dealing with a housing shortage in this country. The second factor to take a look at is new construction starts. So we know that there has been an unprecedented amount of new deliveries that have been coming to the market over the past couple of years. The interesting fact is that from fourth quarter 2022 through the third quarter of 2023, new multifamily starts have dropped by over 50%. So as we move forward, vacancy rates, which have increased a little bit because of the new units being delivered, and even could increase another percentage point or two, but once that gets absorbed, there's not much coming behind it. So that pendulum is going to swing back, putting further upward pressure on rents. The third and most important factor is that there is an enormous amount of capital on the sidelines right now. And this capital is waiting for the right time to jump back into the marketplace. As Lloyd Blankfein, former chairman and CEO of Goldman Sachs, stated on a recent Marcus & Millichap IPA National webcast, if you're sitting by the phone waiting for it to ring so someone can tell you the market has hit bottom, it will never ring. My point is that now is a time to be preemptive. Now is the time to analyze the market, understand what exactly you want to go after, and then go after it very, very aggressively. There's a limited number of deals that are coming to market at this time, but that will likely change. The other part of it that's going to dramatically impact the lay of the land or the entire landscape is all of that capital on the sidelines. As that capital starts coming into the market, it's actually going to be more difficult for people to get deals done just because of the amount of competition that is going to be going after every single deal. And this is why the most experienced investors that I'm talking to today are aggressively pursuing transactions in today's market.
Okay, so can you guys hear me? Did you all hear the video okay? Did you hear the sound in the video? Was the quality good? Just say yes or give me a thumbs up. Okay, so hey, let's do this. What I've done, and I know that went really fast, and there's a lot of information in there, and it was just done October 12th. So anybody that wants to see it, again, it's not mine, go to the Marcus & Millichap website, look under the research tab, and play the video. And then you could get access to a lot of market data that they do. You know, they have the third quarter of 2023 is completed, and they have like 74 market analysis on 74 different markets. And you could go in there and you got to subscribe and be a subscriber, which means you put in your name and email, but you could look at all the market data they have so you could see it for yourself. Okay. So what I've done is I took this short video, I'm going to deconstruct it, and I'm going to share with you my 22 years of perspective. And then we're going to come up with a plan on what we could be doing to win, because some of us are going to win big, and it's going to be those people that are prepared. Okay, so that's what we're going to do. So I'm going to go back to the PowerPoints, and let's go back and share here. So the first thing he talked about was, well, let me just go back here. The first thing he talked about is your strategic factor is you got to know what cap rates are. And cap rates right now are between 5.5% and 6%, okay, depending on the market and the property class. And I'll show you the data that supports that. The next part is you really got to understand what type of debt is available. And I'm going to add to that, and it's the third point, is you really got to know how to underwrite the type of debt. And all negative leverage is, and see, some people will say like, well, look, if I get a loan at 6.5% and the cap rate's 5.5%, that's the definition of negative leverage. And some people get caught up in that, but I don't. Okay. And the reason I look at it, but I don't let it stop me from doing a deal, because at the end of the day, I'm looking at what I'm buying it for. And then I'm going to look at a forward-looking 5-year projection with realistic assumptions. Okay. And so the leverage piece is just one component of what makes the deal go. Okay. It's just one component. And so I'm going to get into everything that he said here. The key is that there's a lot of investors are being aggressive right now because the fundamentals are strong. There's a housing shortage. There's billions of dollars on the sidelines waiting to be deployed. And as soon as there are signs that the market has bottomed out, it's going to be too late. And there's going to be a frenzy of competition. And so for that reason, a lot of investors, including myself and some of my top students, are being very aggressive right now in taking action. The next thing that he said was that there has been a lot less transactions happening. Okay. And I covered that 2 weeks ago. So what that means is there's less deals for sale. And so even though, we're in a more buyer-friendly market, there's just not that many deals for sale right now. Okay. So that lends itself to, the actions that we need to be taking that I'm going to summarize here in a moment. We're still in a inflationary market, and I can see here that I forgot to delete. Just ignore that second screenshot above, that shows multifamily fundamentals continue to maintain strength. That's important too. And I just forgot to edit that out. But, we're still in an inflationary market. The Fed looks at the core PCE, which is the core personal consumption expenditures. And that's basically what people spend money on minus food, minus energy. And so that core PCE is targeted to be 2%. And as of the end of August, it was at 3.7. And that's why the Fed doesn't want to lower rates. That's why the Fed may raise rates one more time by the end of the year. Okay. But we could see it's down. It's that core PCE number is down from where it was, a few months ago or several months ago. And so are all the other metrics. So this is the slide deck that I didn't edit out, and I just created a new slide. That charts and graphs that were on the other one. We could see here, and John Seabury said, vacancy is still low, which it is. And rent growth is still positive at 3.1%, which it is. And so what happens is, and I'm going to show you another chart that shows the number of new completions is down 50%. So what that means is, as more households are being created, which they are, and there's less and less completions happening in the future, which you could project out very accurately because it takes 2 to 4 years to get a project online. So it's easy to tell how many new units are going to come online. And so the new completions are going to go down. There's still a shortage of housing, and that's going to put vacancy. It's going to reduce vacancy, and it's going to drive up rent growth once again. So that's what's going to be happening in the next few years. This is a repetitive slide just showing that we have roughly 4 million units of housing shortage. And this is the slide that I referred to that shows from October last year to right now, multifamily constructions are down by 50%. Okay, 50%. And the thing is, it takes a few years. Like if they start doing projects again, it's going to take a few years for that to catch up. So we're going to have a window of a severe housing shortage where there's more households being formed. The affordability gap between buying a home and renting a home is going up. There's more households being formed, and there's less units coming online. So to me, doesn't it just make sense that just looking from those factors alone, doesn't it make sense that this is a good industry to be in? I mean, you guys tell me, like, put in the chat, like, does it make sense to you or not? Like, it makes perfect sense to me. Okay, it makes perfect sense to me. So the next thing I wanted to share is what John claimed about the dry powder. So we can see here that besides 2021, there's more dry powder now than at any time in the last 13 years. And so the institutions and the family offices and these people that are, smarter than we are, they're all sitting on the sidelines. Many of them have pencils down and they're all waiting. But once they stop waiting, it's going to be harder for people like us, for individual syndicators, for people like me. And yes, I'm putting me and you in the same category because, I may have more experience than you, but I'm not an institutional buyer. Okay. I'm doing the same thing you guys could be doing, which, I just have 20 years of experience, but I'm analyzing markets. I'm underwriting deals. I'm making offers. I'm clarifying what I want and what my business plan is. I'm getting super crystal clear on that, and I'm taking action. And that's what you guys could be doing. Okay. So that's the message. So I love this quote here that was from the former chairman of Goldman Sachs, where he said, if you're sitting by the phone, I've never seen this quote before, by the way. If you're sitting by the phone waiting for it to ring so someone can tell you the market has hit the bottom, it ain't ever going to happen. Okay. There's not going to be a report in the Wall Street Journal that says, hey, we're at the bottom. Now you can start investing. And by the time that report comes out, it's going to be 3 months in the past. It's going to be 3 months in the past. Hindsight is always 20/20. Okay. And as that capital starts coming in, once it does bottom out and once the corner turns, all that capital is going to be flooding into the market. And this is why, like, for me, I have a sense of urgency right now. Like, I really do. I have a strong sense of urgency that I need to find deals. Okay. And the thing is, if we look at the cap rates, on average, cap rates were at just above 4.5% last year at this time. And now they're just below 5.5%. And if we look back in history, we're at the same cap rate now than we were in 2018. So, and pricing has gone down. So, like, to me, it's like, if we're waiting for the phone call to ring, and I know some of the naysayers might say, but what if the price goes down even more? What if the cap rate goes up even more? Yeah, but what if it doesn't? Like, the fundamentals are strong. And I don't have a crystal ball, but we have an election coming up in just about a year. And when elections come up, politicians tend to do short-term things to make things look better. And so, I am not saying that's going to happen, but I could say it's happened in the past. So we're going to be in a position now where that phone call that says we're at the bottom of the market ain't going to happen. Okay. So I just want to give you guys some confidence that there's a lot of data showing that now is a great time. So here's the key takeaways, because I said I was going to talk about what we need to be doing right now and going into 2024 so we could be successful, so we could be prepared, so we could win. Okay. And these are the 6 things we need to be doing. So number 1 is you got to be really crystal clear on selecting the great markets. And for those of you that watched my training on October 3rd, that is going to be your guideline. Because I went through a lot of charts and graphs. Today, I gave you the quick summary of that. And if you're watching this on video and you didn't watch the first training, you should find it in your inbox, because I know we sent out the recording to everybody that whether you watched it or didn't watch it. Okay. And Sunrock team, I also know that people registered for part 2, but they didn't even register for part 1. So could somebody on the Sumrock team also make sure that everybody who registered for this training, part 2, also gets the recording to part 1? I want to make sure everybody has that. Okay. So that is step 1, is you got to understand how to select the right markets. And I gave you the recipe. I gave you the guidelines, and I gave you the top markets. Okay. So you should have that. Step 2 is now more than ever. And look, I've been teaching this for 22 years and doing this. Okay. Teaching it for more than a decade and doing it for 22 years, is you got to get crystal clear on what you're going to buy. Okay. Some people are like, oh, I'm just looking for a good deal. Well, let me ask you this. If you're going to buy a car and you say, hey, I'm looking for a good deal on a car, as opposed to saying, man, I'm going to use an example of something that I did 2 years ago. I really want to get a Ferrari 458. Isn't that a little bit more specific than just saying I'm looking for a good deal on a car? Isn't it? If you guys could nod your heads or put it in the chat box. Yes, Brad. So the more specific you could be, see, as soon as I said I'm looking for a Ferrari 458, I started taking action. And I went on Auto Trader, and I went on Kelley Blue Book, and I went online and I found Ferrari 458s for sale. I didn't know what they cost. I didn't. Then I started looking. I started looking at what they cost, what people valued, what models people valued, what colors people valued. I got to know the market. Then I started making offers, and I realized that when one comes on the market, they sell like within a day. And I would look at the car for 2 weeks and think about it and want to go test drive it. And then I'd call the dealer back, and he'd be like, it's gone. And I'm thinking, okay, that's bullshit. How could it be gone? But after losing a car 3 times, I realized that that's the way people buy Ferraris, because they know what they want, and they've researched the market, and they probably did the same thing I did. They missed out on their first 2 or 3 deals because they didn't know the market, but they got to know the market. And so the one that I bought actually came available in Dallas. And I went to see it the same day it came available, and I put the check down, a $95,000 deposit to hold the car. But the first 3 ones that I made an offer on, I missed because it took me 2 weeks. And after going through a 2-week process and then being disappointed, I was able to do my analysis and make a decision in a day. Okay. So you got to get clear on your criteria, and your criteria is, where are you going to buy? What's your pricing that you're going to buy? Like, are you looking at a $5 million deal, a $10 million deal, a $20 million deal? Is it a value add strategy? What type of debt? Is it a heavy rehab? Is it a light rehab? So all these things you got to get clear on in steps 2 and 3. Get clear on what you're going to buy. Select your market, analyze the market, know the market. Get clear on what you're going to buy. Like, you should be able to tell your investors, even before you find a deal, you should be able to say, hey, I'm looking at a deal between 150 to 200 units in Dallas or Tampa. And my ideal property is going to be a 1980s property with a lot of classic units that I could go in and upgrade and raise the rents. But I need to find a property that's surrounded by other properties that have already raised the rents, so that I'm not guessing. And I'm looking to find that diamond in the rough property with a lot of classic units in a proven submarket with demographics of at least a $60,000 a year household income. So see, now I know what I'm looking for. So if somebody sends me a deal in Kentucky, I'm going to say, no, I don't want it because it's not in Dallas or Tampa. And if someone sends me a 50-unit deal in Dallas, I'm going to say, no, it's too small. And if somebody sends me a deal that's between 150 to 200 units in Dallas, but I do the research and see that the average household income is only $40,000 a year, I'm going to say, no, the demographics are not what I want. You see what I'm saying? So I'm not going to waste a lot of time on deals that don't fit my criteria. Okay. If they send me a deal that fits my criteria in terms of size and location, but all the units have been upgraded and there's no value add, and I want to find a property that has a value add potential, I'm not going to buy that one either. Okay. So it's so important to be clear on your market, your criteria, and on your strategy. Does everybody get this? Okay, you got to be crystal clear. Give me a thumbs up or type in the chat like, yes, Brad, like you got to be clear on this. Okay, because so many people are out there looking for, quote, a good deal. And then next, you got to understand the debt options and the interest rates that are out there. And when I say understand it, you're going to need to be able to find these deals that meet your criteria on paper, but then you're going to need to analyze them. And so you got to be able to underwrite deals, and you got to be able to underwrite them efficiently. And you need a good tool, and you need a process. Okay? You can't just wing it. You got to be quick, efficient, accurate, and you got to know what's going on with debt right now. And then now more than ever, we heard John Seabury say it, like in the past, look, property management has always been important, but because we had so many winds at our backs, a tailwind, property management could be a little less efficient, but because rent growth was so high and, cap rates were continuing to go down and interest rates continued to go down, you could have been average and still made an above average return. Now you have to be good to make a good return. You can't be average in property management. So you really want to understand how to efficiently vet a property management company. Okay, because most of us are going to go syndicate 60 plus units and we're going to hire a management company. And you got to know how to vet and select that management company. And then either you or somebody on your GP team, your syndication team, needs to be the asset manager. Okay. And I see, some of you out there, I see some of my students out there, like I am not the asset manager on my deals, but I partner with some of my students that love doing the asset management because somebody needs to do it. Does that make sense? Okay. And then the last one is you got to be ready. You got to be ready for the opportunity. So let's do this together because this is how you get ready. Okay. And on this slide, by the way, and this is like a 24-page PDF document that talks about an apartment investing blueprint. And so I'm not going to go through all 24 pages tonight because we don't have time. But what I wanted to go through is that if you look at these 4 steps are part of what I call my investing framework. So every deal that I do and everything that I teach my students that are in my 1-year mentorship program, I really make sure they get dialed into these 4 things. And so just rate yourself. Like I want everybody do the best you can and type in as we go through this, type in the chat your numbers. Okay, type in the chat your numbers. So the first question is, if you had to rate yourself on a scale of 1 to 10, with 1 being very low and 10 being I'm an expert, how well do you understand the deal? Like if somebody presented you a deal and you looked at the analysis, do you understand cap rate, NOI, rent growth, operating expenses, vacancy rates? Like, do you understand that and how to come up with those numbers? So I just want you all to type in your number. Okay, I see 7.5, 8, 5, 7, 10, 9, 2, 1, 4, 9, 8, 9, 10, 5, 1. Okay, that's great. So like, let's be real and honest, and that's great. So let me go to the next one. I know some of you answered all of them. Those are the overachievers in the group. Okay. The overachievers in the group. So the next one, I'm trying to move my chat box, by the way. How do I move the chat box here? Okay. The next one is finding the deal. So on a scale of 1 to 10, what is your level of confidence and effectiveness in getting brokers and owners to send you deals? And then in the same number, once you get the deal, do you have a quick and efficient and accurate way to underwrite or analyze it? Okay, so again, finding and analyzing deals. Let's type in your skill set. 1 is I'm a newbie, and 10 is I'm an expert. Okay, I see a 5, I see a 1, I see an 8, I see 6 to 7, I see a 1, I see a 7, I see who else? I see a 2. Okay, so look, that's great. Some of you are good at this, and some of you are just beginning, and some of you, like, I'll just tell you this. I wouldn't rank myself a 10, because every time I think I'm at a 10, I find out there's another level. I'm just telling you, that's me. Every time of my life where I think I'm a 10 in anything, fitness, health, energy, money, real estate, anything that I felt like I'm a 10 at, I realized later on that I wasn't a 10, that I was a 9 or an 8, because there's always another level. There's always another level. So let's talk about the third foundational category, funding the deal. Funding the deal. On a scale of 1 to 10, are you confident that you could get funding? Are you confident that you could raise the money? Do you understand right now, the options between agency debt, bank notes, life insurance companies, the type of financing that's even out there? So let's talk about debt and equity, accessing it and understanding the options. So 8 on debt, 5 on equity. 2. Anybody else? Thank you, Michelle and Scott. 4, 2, 4, 5. Okay, this is great. 3, 2. Awesome. Okay. And then the next one is, do you understand all the nuances that once you find and analyze the deal, is how do you get it under contract? How do you make offers to get the broker's attention? How do you go through the due diligence? And what are the things to look for and to not look for? And what are the things where you would walk away from a deal and the things that you wouldn't walk away from a deal? Okay. And how do you vet the management company and hire the management company? Okay. And how do you do the asset management? So that's all under number 4. I know it's a lot, but it's basically closing, managing, and exiting the deal. So again, on a scale of 1 to 10, where would you put yourself? 7, 8, 1, 1, 2, 2. Let's see, 1, 1, 6, 3, 8. Awesome. Okay, this is great. For those of you that participated in this, thank you. I mean, I'm not saving your results, but it's just great to see the openness and transparency. And look, hopefully this was beneficial to you more so than to me, because I'm not going to remember your numbers, but hopefully you remember your numbers, because these numbers represent where you are, and there's a gap between where you are and where you need to be. Okay, so if you didn't give yourself a 9 in every category, and the reason I say a 9 is I wouldn't even give myself a 10, but if you gave yourself a 9 in all 4 of these categories, then you are probably at where you need to be. And if you didn't give yourself a 9 in any one of these categories, then there's a gap. Okay, there's a gap. And so we want to be able to close that gap, and the gap doesn't get closed overnight. Okay, but we want to move and progress every week, every month, every year. We should be working to close that gap. Okay, so adding to how to get ready is you got to learn these 4 things. So when it says learn the 4-step framework, it's you got to understand the deal, step 1. You got to find and analyze deals, is step 2. You got to fund the deal with debt and equity, it's step 3. And then you got to get it closed and managed and exited. So you got to learn that. And that's pretty much it. But just to add to that And part of step 2, which is finding and analyzing deals, is you really need to learn to underwrite deals in today's market. If you're underwriting deals the way we used to underwrite, with 80% loans and 3% interest rates, or with variable rate loans and rate caps, like, we need to understand how to model deals with the debt that's available today. And then number 3 is, I know it was in step 4, it says closing and managing and exiting the deal, but now more than ever, we need to focus on how to vet and hire management companies and how to be an effective asset manager. Okay. So this is what we need to be doing. And honestly, I'm at a 9 in these categories, but I'm doing it. I want to get to a 10. And then as soon as I get to a 10, I'll realize I'm not at the 10 and I'm still at a 9. Because there's something else I didn't know. There's a new distinction. There's a new market condition. There's a new nuance that I wasn't aware of. Okay, we all are. Okay, so we're always learning and always getting ready. And one of the biggest questions that I get asked is, Brad, could you help me do this? And of course, this is what I do. Okay, so the answer is yes. And I'm doing an event that I want to share with you, and it's just about a month away. And it's going to be in Dallas, Texas, and it's limited to 100 people in person. And unlike the picture that you see here, where we had close to 1,000 people in the room, this event is limited to 100 people in person. Okay, so this event is more of a workshop than a seminar, and we're not going to have fancy lighting and music and all that type of stuff. We're going to roll up our sleeves and get to work on learning the framework and on analyzing deals in today's market conditions with today's debt and equity requirements. And so what's going to happen is, this is an intense workshop. It's limited to 100 people. It's going to be a workshop format. Everybody will have a chance to ask questions, and I will be personally there conducting the entire event and answering your questions, me personally. Yeah, my team will be there with me, but I will be leading this event. This is not a multi-speaker event. This is me teaching and working with you for 2 days. Okay, and I've never done an event like this before for the public. And you're going to learn my framework, and we're going to use my property analyzer, and we're going to underwrite deals. And I'm going to teach you how to vet management companies and do effective asset management. So that's everything that's going to be covered in a 2-day workshop. And I got a couple bonuses for people that are going to come in here. One is, you're going to get what we call our apartment investor self-assessment and implementation call. So before the training, you're going to do an assessment that's a little bit more robust than what we did today with the 4 questions where I asked you to rate yourself on a scale of 1 to 10. And then after the training, you're going to have a one-on-one call so that you know exactly what you need to do to move forward and hit your goals. Okay, so that's going to be bonus number 1. Bonus number 2 is, I'm going to give you my home study course, and you can see the topics that are covered in my home study course. I'm not going to read them all, but it covers a lot of basic information about some of the things that we talked about tonight. Number 3, and this is a game changer, is that up until now, the only people that have had access to the proprietary Sumrock property analyzer were my students that invested in a 1-year mentorship program for $34,000. And everybody who comes in person is going to get this included, because you need it, because we're actually going to use it, and you're going to bring your laptops. And part of the workshop will be analyzing deals that I'm going to pass out deals that are on the market, and we're going to analyze them in class together, okay, using my property analyzer. And then number 4 is, I'm going to train you on how to use the analyzer before you come into class. So you're going to get training on how to use the analyzer. So when you come into class, you already have some familiarity with it. So here's the summary. There's going to be a 2-day workshop, the self-assessment, the implementation call, the home study course, the property analyzer, and the training. And there's a total value of everything that we put together here of over $5,000. And you could come to the workshop for $797 for the first people that register, the first 50 people that register. And my team tells me that there are 22 tickets left at the $797 price point. So I know some of you already bought this ticket because I mentioned this event after October 3rd, but some of you haven't. And so I really want to encourage you that if this sounds like, look, some of you know that you're inclined to take this training. You know you need the training. You know you're going to benefit from the training. And as a result of this workshop, you will learn and progress on closing that gap. You will learn how to understand the numbers and the projections. You will learn how to find and analyze deals so that you're not wasting your time or the broker's time. You'll learn how to make offers that get accepted, and you'll learn how to model the current debt. You're going to learn the steps to raising money, and you're going to learn the steps to closing and operating your deals. Okay. And we're going to spend time, real time, using my property analyzer, analyzing deals in class. And so what that means is when you leave this training, you're going to be more likely to be able to get deals and analyze deals and make offers and get them accepted and get them closed. Okay, so that's the outcome. So for those that are ready, if my team could also put the link in the chat box, there's a very simple QR code that you could take a picture of, and you could go ahead and register. I do expect these 22 remaining tickets at $797 to be gone shortly. Okay. And we have not yet been aggressively marketing this event, but we will start to do that after tonight, because we mentioned it on part 1, October 3rd, and we're mentioning it again, October 19th. And we really were wanting the people that registered for this training to have the first opportunity to get one of these 100 tickets. Now, I've instructed my team to start marketing this to our database of over 50,000 subscribers and followers on emails and social media and our newsletters and stuff like that. So I'm not here to pressure you. I'm just here to encourage you and let you know that we intend to sell out the in-person experience. And so if this is something you feel called to do, I would encourage you to take action tonight. Or if you're not listening in person and you're watching the recording, I would encourage you to take action as soon as you get this information. And I just want to conclude by showing you a few success stories. This is Venkat and Sri, and they came into my ecosystem, and within a few years, they bought 1,300 units. Their net worth increased by over $4 million. Okay. And also the Staples. They came into my program. They were both employed. Bonnie was a 6-figure employee at Bank of America, Merrill Lynch, and Carrie was a 6-figure employee at IBM. Bonnie quit first after 2 years. Carrie quit second after 4 years. And this is outdated. They increased their net worth by $3 million, but now it's a heck of a lot more. I think it's by like $14 million. Literally in the past 7 years. So I just wanted to show you a couple examples of what's possible for people that decide to take action and get started. So I want to finish by thanking you for being here tonight and for watching this live training. And whether you come to the event or not, which hopefully you will, but hopefully you got value by understanding why now is a good time and the steps that you need to be doing to get ready for the coming opportunity. So I'm going to stop the slide deck, and I just want to share with you guys like a personal story before I go. And many of you know that I got started, and I give Robert Kiyosaki's books a lot of credit. And I say that Kiyosaki's books changed my life. You know, I say that, you know, I was an engineer with an MBA, and I was studying for my law degree to get my 3rd degree. And Rich Dad, Poor Dad came out, and I read that book, and it changed my life. But here's the secret. Reading the book didn't change my life. Reading the book just gave me an idea that there was something different out there. What changed my life was the action I took after reading the book. And the action I took is I went to a 2-day event. and I learned the system. I learned the framework. Okay. And that guy ultimately became my first real estate mentor. And so it wasn't the book that changed my life. Like, books don't change lives. Actions change lives. This training may motivate you and inspire you. And I hope I added value and gave you content. But if all you get is a screenshot of my slide deck and you don't take action, it's not going to change your life. Okay. Coming to Weekend to Wealth, November 18th and 19th, and investing in a weekend in yourself is going to move the needle. Okay. So whether you're listening to this now, which some of you still are, or whether you're listening to the recording, it's the action you're going to take right now that could potentially change your life. And that's why I'm doing this event. And it's limited to 100 people. I haven't done it before, and I may not do it again. We'll see how it goes. So I just want to thank everybody for being here in person. And I want to thank those of you that are watching the recording. And hopefully I'll see you November 18th and 19th in Dallas. And one question that we've already been getting is, could I bring somebody like a spouse, a business partner, a family member? And the answer is yes, but there's no 2-for-1 because we're limiting it to 100 seats. Every single person needs to have a paid seat. So imagine this is like an airplane that's flying from Dallas to Miami, and there's a limited number of seats. And so I know I've done bigger events where, I'm trying to get as many people there as possible, and it doesn't take much to add an extra chair. And so, like, sometimes we've done BOGOs and all that type of stuff, buy one, get one, or buy one 50% off, but we're not doing that here because we're truly limiting it to no more than 100 people, and it might be less than 100. Okay, we may end up capping it at 50, but my commitment is there will not be more than 100 people in the room. So again, thanks everybody. And yeah, Cynthia, I see you have companion fare with Southwest. But I mean, I'm giving you all the best deal that's possible, which is $797 for the first 50 people that grab a ticket, and there's still 22 left. So that will be the best that we could do. And there's not going to be any offers coming out later that have a lower price or a discount or anything like that. We don't roll that way. Okay. So I know some of the big name people do, but we don't do it that way. So anyway, I will see you guys hopefully November 18th and 19th. And the other question is, if you're one of my current mentoring students or mastermind students, I mean, of course you could attend this training, but I want you to know that in those programs, the mentoring, the 1-year mentoring and the 1-year mastermind program, we will also be covering this material outside of this training. So I don't want my students to feel like they need to be at this event. Again, you can come and I'm not going to turn you away, but I don't want you to feel that you need to be here. If you're in one of my, these are like $35,000 a year programs. So of course I'm going to cover this for you if you're in those programs. Okay. I just wanted to make sure that you guys are aware of that. All right, folks. Thank you so much. I'm going to say, I'm not going to say goodbye, but I am going to say good night.